Good morning, everybody. Welcome to episode 51 of Talk Your Chart. I am Brett Horowitz, and unfortunately, Marcos is not here. He's out of town visiting clients, so I'm gonna have to find someone else to host with me today. Welcome. My next possibility for replacing Marcos on Talk Your Chart is the wonderful Steve Foldis. Steve, you got a lot of years in service, a lot of things to talk to us about. I'm sure you'd be a terrific host. What would you bring to the table?
Well, first of all, Brett, I'm not sure about the term wonderful, but that's okay. I would probably bring to the table my ability to talk about, how I would talk about, not messing things up too much. Wait a second, wait. So, what, Brett, what's going on?
No, Steve. Now you're muted, Steve. Now we can't hear you. You're now muted.
Oh, I'm sorry. Maybe not. Uh, Maybe I'm better off just directing it with face to face as opposed to all these newfangled gadgets.
You hit the mute button again, Steve.
Oh, I'm sorry. I'm sorry. Good morning, Brett.
Morning, Flavio. So
I'm
you are,
so I'm so excited I've joined an episode here of SYS. Like I have everything to show you guys. I have
what?
all the stats. We're gonna talk about the Heat ending their 7-game losing streak.
Hold on. No, this is Talk Your Chart.
No,
We talk about economic charts.
no, speak your stats, right?
Speak your stat. That's, I think, the next room over. Welcome, David Evensky. Maybe our next co-host. You're here to fill in for Marcos. Is that right?
I am, a matter of fact. And Marcos, I got to tell you, Brett's been doing things all wrong. So I appreciate the opportunity today. I have something I call my pie charts. You guys do all these fancy things, Phillips curve, PPI, CPI. You need to speak to the common man. So I've brought with me a couple of my charts, pie charts. This is my TV consumption efficiency. The amount of time I spend looking at for something to watch TV, 98%. And the amount of time actually spent watching something, that 2%. See, these are the kind of charts that you need to be showing. Let me just share my final chart with you. It's called I Asked You First. Where do you want to eat? I have conversations with my wife all the time. This is my allocation of weekly mental brain power. As you see, small part of work, fun things to do, cure cancer. But the majority of my time is deciding where to eat. See, Brett, these are the kind of things your audience needs to know. Just because Marcus is out of town, this is your opportunity. I can sweep in here. I can bring my whole load of charts. I got charts. I got bar graphs. I got all sorts of other charts. I can show you everything, and it's real stuff. Real people that want to know that.
Okay.
I'm the guy to replace Marcos. I'm already in his office. I've locked the door. Let's go.
Welcome, Michelle Panzera, our marketing director. You're the one that helps put these Talk Your Charts together. So why do you think that you'd be a good host to replace Marcos?
I think we really need a woman's perspective on Talk Your Chart, and not just a woman's perspective, like a radical feminism perspective. And I think that all money leads back to men and women. And I'm here to give that perspective and make sure everyone knows that women are the only people that should be managing money.
Whoa. Marcos and I do a pretty good job of keeping things gender neutral. You want to now shift it all to why women rule the world?
Totally. Men have ruled the world for hundreds of years. It's our turn. And I think Talk Your Chart should really be setting that standard.
So welcome, Michael Walsh, my partner and my colleague here. So potentially you're in the running to replace Marcos as Talk Your Chart co-host. You know how this works, right? 20 minutes, a couple of charts, and we go through them rapid style pace. That works for you, right?
It really reminds me of a time when I was in kindergarten. It reminds me of another time in the third grade. Then I want to say probably in high school and volleyball. Indoor volleyball was something that was very, very intense. Your question really reminds me of something that Warren Buffett once told me. There we were in Omaha, Nebraska, and he said, Michael,
What happened? Mike, where'd he go? Okay, well, I just got done interviewing 5 people that I thought could replace Marcos. I'm ready to record, but he's not here. And I don't know. The guy's just so good at what he does. I miss him. I think we're good together, and I need him to come back. So Marcos, if you're out there, please hurry back. Come back safely. I need you for Talk Your Chart. You and I, we're the only ones that could do this. Come back, man.
Welcome to episode 51 of Talk Your Chart. I am Marco Segrera here with my partner Brett Horowitz, and I am back after a week's hiatus visiting clients in California. and I was pleasantly surprised by our cold open for this episode that I did not have any hand in. And Brett, you very creatively got a few folks to fill in for me while I was out.
Yeah, I'm glad that you did not find out our secret mission while you were gone. But unfortunately, they just couldn't cut it.
I get it.
So
It's fine.
me and you going forward.
Yeah, for now, it's us. You didn't interview everyone, so there's still some folks out there, and we'll see how the roster turns over. On to episode 51, where Mr. Horowitz, I would like to start off with a wonderful little piece put out by our friend Sam Rowe over at TKer, TKer. It's a Substack that he does. And it's a wonderful little title called Don't Confuse Your Relatives with Your Absolutes, which is a wonderful title for talking about the economy right now. It's slowing down, and everyone's throwing out this absolute sense of things are good or things are bad. In reality, we're 40% up from the October 12th, 2022 low on the S&P, which is an excellent thing. But when people talk about prices or wages or job growth, people are saying it's bad. A quick overview, BH, before I look at the charts. So recent months, the economy's entered a phase where it's still growing, but growth is decelerating. How labor market is cooled. Consumer finances have gone from unusually strong to more normal, and surging capital expenditures have leveled off, but at record levels. So the first chart that I bring you here from the Bureau of Labor Statistics and the Fred website is total non-farm payroll. And if you look at the two red arrows, what it's pointing to in the first one, which is lower on the chart, says job growth has been strong. Because when you look at that initial bar coming off the one just before it, there's a big jump from one to the other. And what's funny, when you look at the next reading, you see job growth has been decelerating. However, it's still greater than the last bar. Why? Because we're still growing, just growing at a slower pace. Again, this idea of on a relative basis, lower, slower, but not bad.
It needs to happen, right? We talk about this over and over again. The economy has been so hot the last few years. We're getting the stock market in 2022, but it's been hot. People have been spending a fortune. And so you need this to happen. So talking about, on top of that, the next chart, quits rate, that also, when we talk about the jobs number that just came out and the number of people who are quitting, it's down from a record 50 million people quitting in 2022
Quitters.
to only 44 million. And so they say, wow, quits are down. Of course, quits are down from the all-time high. Quits is typically a sign that when people are quitting, the economy is rocking and rolling because people feel confident. And when they're cutting back, they're less confident. But to your point that things are, slowing down but still healthy, the job openings has now come down from 12 million job openings with 6 million unemployed to 9 million job openings with 6 million unemployed. Only about 1.5 jobs per unemployed person. That's good news.
Yeah, that's a huge jump. Remember when it was almost double? That was an impressive sight to see.
Yeah, it's still higher than where it was pre-COVID, but at least it's come down to something that's approaching something more normal.
Yeah. Yeah, without a doubt. It's funny to see how the two lines on the chart intertwine. So continuing on this idea of relative versus absolute, the next chart here again from the Fred is the personal consumption expenditures, which is again basically another measure for inflation, shortened usually as the PCE. And if you look at it here, the biggest economic story of the last 3 years has obviously been inflation reaching their highest levels in 4 decades. And since peaking in early 2022, you have inflation rates coming down. What does that look like? Well, here's what it looks like. PCE almost fell off a cliff, right? It's like throwing a rock into the ocean and it's just coming down and down and down. However, that's relative. Let's go absolute. That's the next chart again from the Fred. When you look at the personal consumption expenditures, things are still more expensive. What the chart is reflecting is the relative measure is that the pace at which prices are rising is slowing. Prices are still rising, but they're not rising at a rate that is absolutely punitive to the consumer. And another quick point that we can't go deep into here, but if people think inflation is bad, they should read about deflation.
Oh yeah, we talked about that, how bad it was in Japan and how now China's seeing it. Jerome Powell was on 60 Minutes on Sunday. You probably did not watch him,
I did
but
not.
he basically said the same point, which is if you're expecting that all of a sudden now that inflation story's ended, everything's gonna be a lot lower than it was a few years ago, like that's not gonna happen. Things do not generally go down over time. They just go up by a slower percentage. So all those prices we saw 3 years ago for eggs and milk and gas and TVs and whatever cars, like we're not going back to that. Just not going to have these these asteroid like explosive growth elements to them. So which is just healthy. That's what it normally happens. We normally go up 2 or 3% per year.
It's going to happen. Price of milk is going to be more expensive 10 years from now. Quick point, because you brought up Jerry Powell. Someone asked me the other day because they noticed that photo was not Jerry Powell anymore. That photo of Jerry Powell was replaced by Billy Ray Valentine and Lewis Winthorpe III. If anyone knows that movie, let us know in the notes or however the heck you can talk to us through this channel, and Brett will send you a TYC shirt if you can name the movie.
No, I think we talked about this already. We know who those people are because you could not think of the actor that played one of those characters.
Well, guess what? Now I know everyone. If you know the movie that Billy Ray Valentine and Lewis Winthorpe III are in together, let us know. We'll send you a t-shirt. Brett will send you a t-shirt.
Yeah, great. Sure. It's in the mail. It's coming. So we got a lot of data the last week, and jobs obviously very high, very important in that. Inflation is very important in that. But I think something's going unnoticed, which is Europe and how weak Europe has been vis-a-vis the US. So I want to start sort of with the negatives, because I think that these last few years for Europe have been pretty trying times for a number of reasons. So we know that in his first chart, GDP for Europe has been weak. It was basically unchanged for the last 3 months of 2023. And for the entire year, Europe GDP was only up 0.5%. So their expansion, their consumer spending, quite low. We know that's partially due to the energy prices over there, whereas we are natural energy producers, natural gas producers, so it doesn't hurt us as much. We know that then the supply chain has been disrupted by everything going on in the Middle East, which hasn't affected us as much. This interesting story that I was not aware of, under the Wall Street Journal heading that said, America innovates, China duplicates, replicates, and Europe regulates.
That's quite a headline. That is quite a headline.
They were saying, and this was surprising to me, that in Europe, just as an example, they have not allowed cell phone carriers to merge. As a result, there are 43 groups running 102 different mobile operators, serving 474 million people. The US has 3 carriers, basically, running the entire network for 335 Americans. So they said, okay, is that good? Is that bad? The positive is that European customers spend 1/3 of their money on cell phones that we do. Their bills are significantly lower. You say, great, I want to live in Europe. The problem is they invest about half of what we do on their network because they don't have the income coming in, the cash flow. So the quote in the article was, getting a 5G signal is the equivalent of finding a Biden supporter in a Trump rally.
Perfect.
So Europe's got a lot of struggles with them in terms of the fact that we do know they don't like competition. They have a lot of rules related to, providing information to their consumers, to this GDPR rule they have. Like, it's just not a great place to be if you're a company.
No, and they're not getting any better. And a lot of what's going on in Europe and in the UK is making companies reconsider any mergers. And you saw it with the recent blow up of the Adobe Figma deal that UK messed up.
Well, to that point, Europe is so beaten up right now that the Magnificent Seven stocks, right? Your Apples, your Netflix, your Metas, your all those. As of 2 weeks ago, those stocks were worth collectively more than all the European stocks put together. Wow, like that's unbelievable. So you look at it, and those stocks keep going up and up, right? NVIDIA just keeps going up and up. It's now like a P of 90. It's just never goes down, it seems. So you think, okay, all this is so bad for Europe. Why the heck would I want to invest in European companies, in European stock market? Right? Right? You're with me so far?
So far, I'm hanging by a thread, but I'm there.
I've got 3 reasons why, and the article points to 3 reasons. Number 1, European stocks are not the European economy. So if you're betting on European stocks to be the European economy, it's not the same thing. So this chart I have here is showing the Euro stocks 600 benchmark and where they get their revenue from. And about half of their sales are not even from Europe. So these are multinational companies that do a lot of their sales overseas. In comparison, about 60% of the S&P 500 companies get their revenue from the US. So they're much more diversified in getting money from outside, whereas we're much more dependent on the US consumer buying those goods and services.
That makes sense because the US is the biggest economy.
Sure. And we spend more and GDP that's why GDP is going up faster, because consumption is the biggest part of GDP. Second chart here is that the MSCI Europe is far cheaper than the US. So the chart I have here shows that every European sector in the MSCI index trades at a lower price to earnings ratio than those in New York and those in the US. And when they looked at the UK, the US, Europe, and Japan, and the 10 different sectors, the UK is cheapest in 5 of them, and the US is the most expensive in 5 of them. So like there's some value in the fact that we are very expensive. And so you're paying for those great revenue numbers with expensive stocks, right? This is built in. They're cheap because they're not doing as well.
There's always been a gap there. There's always a quality premium that you'll pay for the US.
Right. So you put all that together and you say, my gosh, Europe, they're not doing as well. They've got these issues. We know that they don't get as much of the revenue from their own economy and that they're not as cheap. Let's look at performance. Okay. If we look at the performance of the last 2 years, put all this together, they've actually outperformed. So this is a stock showing the S&P, which is in the purple, and the MSCI Europe, which is in the orange. The MSCI has actually outperformed the US going back to the beginning of 2022. So like there's more to it than just the story. There's lots of reasons people buy and sell stocks. It could be that people just are more expecting of Europe to come back in the future, that all these things that happened are in the past, the future is going to look brighter. It could be that we're just more expensive and so they want to go where money is cheaper. It could be lots of reasons, but you can't just take a story of who's doing better, who's got better sales, who's got better regulation, yada, 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 and then, say that's what's going to lead to a higher stock market result.
Yeah, at some point there's probably a mean reversion. So the last 2 years, got it. I think we all knew that we had some European positions that have done well for us. But if you go 10 years back, you got the S&P annualizing at 13 and the Euro Stoxx 50, basically the Dow of Europe, annualizing at 5. So 13 versus 5. That's compounded annual every year for the last 10 years. That's a big difference. Right?
And what does that tell you about the future? Absolutely
Nothing. Or maybe something.
You think?
Maybe something.
Well, the end of the whole article that I read said maybe it's at best to just live in Europe and invest in the US, because there's a lot of European countries that are ranked sort of the best places to live.
Wow, you're moving, aren't you? This is how you did it? This was a pretty elaborate way to let us know you're moving.
To Europe? I mean, there's some nice places in there. I can get by in the French Riviera.
Okay, French Riviera it is. Listener, please, if you know how to get to French Riviera, let's go start a GoFundMe page to get Brett and his beautiful wife, Victoria, out there.
I mean, it'd be nicer if you had a place that I could move into and that I could live, for free.
You're not going anywhere, buddy. TYC needs you. My last chart, I'm pulling a repeater because we all love this one. This little quick one because there's always a little bit of the sky is falling now that we're at all-time highs in the market. Welcome back, all-time highs. If you didn't participate, we're starting to hear that. There's probably going to be another all-time high in the future if history can be any guide. So don't let that be a deterrent. However, let's face the other uncomfortable reality that markets fall. And markets fall often. This chart is showing us, Brett, as we've seen many a times over the last 40 years, the market, in this case, the S&P, has experienced around a 14% drawdown throughout the year. So throughout every 12-month period, you're losing 14% of the value, and that just hasn't mattered. That's water cycle type stuff. That is just the nature of the beast. When markets fall, it's normal. It's opportunity at best. I bring this up especially because I was listening to an analyst the other day on Bloomberg, I want to say, and she said she expects to see a 10% pullback now that the market has clearly found out that it's gotten ahead of the Fed and the projected rate cuts. She said, yeah, I expect about 10%. Anything more than 10% would just be too much and not something that we'd be expecting to see. And I thought to myself, because she has many more years in this business than I do, and I'm sure she studied at somewhere that I couldn't afford. But this chart just leads me to believe that was not a good statement. So I'll take the over on the 10, and I'll say we get closer to a 14 or 50% drawdown at some time this year, because that's what happens.
It's a good headline, but as I talked with somebody yesterday, whether you get in now or at a 10% drop from here, if the S&P doubles every 7 years, which is just about what it does, and then quadruples in 14 years, because that's typically what it does, do we really care if we got in now we're 10% cheaper? Are we going to remember where we got in now we're 10% cheaper? If the S&P is going to go from 5,000 to 20,000 over the next 15 years, like, it just doesn't matter, people.
But Brett, what if I had Palantir Technologies on Monday and you made me sell it on Tuesday, and then I missed out on the 20% rally today in Palantir? What do you do then?
I would tell you, stop owning Palantir and just own the S&P 500.
What about just a little bit?
If you want to gamble, go to the casino.
Rodeo counts. Good to be back.
All-time highs. Let's go.
See ya.